Howdy, Jacob here. Today we're looking at Borgwarner, BWA, automobile components industry, 7 billion market cap, 9 billion enterprise value. They provide solutions for combustion, hybrid, and EV worldwide. Founded in 1987. Growth has not been too bad, honestly. You're looking at mid-single digit growth year over year. Return on asset, mid-single digits, pretty much the same return on invested capital. Looks like dropped a bit from COVID. They haven't been able to get the margins and earnings per share that they had pre-COVID levels. Balance sheet shows 1.5 billion cash on hand with essentially no short-term debt and just under 4 billion long-term debt. So let's look at what 3 billion is in relation to cash flow. 3 billion in comparison to their 600 million is about 5 times. So they do have a good amount of debt here, but no, I wouldn't necessarily say I'm concerned with it. They have been reinvesting a bit, which you can see through the capital allocation or capital expenditures going up, but their cash flow operations has gone up more, so they are producing more cash flow. They do pay a dividend of 1.4% yield, and that is not very much of their free cash flow, which is great. You're looking at probably 25, maybe 20% of your 5-year average free cash flow there. They pay down a little bit of debt, buy back a little bit of shares, make some acquisitions, reinvest. So they're really using all their hats for capital allocation, which is not bad, but you do want them to be most advantageous because everything the company does is a form of reinvestment, is a form of investment for you. So whether it's a dividend, that's cash back in your pocket, share repurchases, increase their earnings per share, buying back shares cheap, hopefully, reinvesting, obviously, creating future growth. So everything they do with their money should be the most advantageous thing that they do. But usually it's not the way. Usually it's not the case. But let's get into some assumptions here. I would say that I probably wouldn't be surprised with slightly above revenue growth here. Let's do a market average P price free cash flow with okay margins and pretty much market average return on invested capital, maybe even a little bit lower, but still fine with that. Margins, they haven't gone up to pre-COVID levels. Maybe they don't. So let's just do a little bit of a range there. 1% of shares repurchased, 70 million to offset stock-based compensation, about 130, and that is about 25% of their capital allocation. I think I'm good with that. So we're saying about 20% to dividend, 25% to share repurchases, maybe 10 to 20% to debt, leaving about 30% to acquisitions, reinvesting, which is roughly what they've done historically and what makes sense to them, possibly. I guess the only thing I'd change, the P price to free cash flow due to the enterprise value, diminish that a bit. So again, I'm trying to base the terminal P and price to free cash flow off of its enterprise value rather than market cap to take debt into consideration in my valuation. And I think that's the most appropriate place to put it. And so, one, it does limit capital allocation when you are projecting for 7 years, but then two, if they still have, $1 billion net debt, then that we don't want to take this in consideration market cap, but rather enterprise value in a lot of cases. So just trying to explain what I did there. So the dividend, fine keeping that the same. That's what they've done historically, pretty much historically the last few years. So I'm good keeping that the same. So we're saying the company needs to drop 19% to get to the return we're looking for here. Honestly, not terribly far off. I mean, these margins might be a little bit high. This might be assuming, they might not get back fully to pre-COVID margins, but are close. We'll see whether that's the case or not. But either way, hope you enjoy the video and have a great day. Thanks.